Chapter 10 is where we look at performance evaluation. And so this is kind of tied into the control function of managers as we're looking at the end of the period, how did the manager do? And we're looking this in terms of a decentralized organization. So a decentralized organization is where managers of different areas are held responsible for the success of their area. So here it says it's not reasonable to expect the CEO to make all of the decisions. We want the managers in charge of the areas to have the decision-making capabilities. So what are the advantages of decentralizing, kind of passing down authority to managers over specific areas? Well, it's going to free up top management's time. They're not being bogged down with having, having to learn about every area of the business and getting all of the detail, right? They need to be able to delegate. So we're using expert knowledge. We are giving the decision-making authority to the person who is in the area, who knows what's going on. It improves customer relations because the manager is being able to get to know the customers. They're in charge of the decision-making. The customer is talking directly to the manager, the person in charge, instead of having to talk to a figurehead in the corporate office. They're talking to the person that they're dealing with. And so this gives the manager then, more responsibility. It's going to help them progress in their career. And so there's a lot of benefits to decentralization. What are some disadvantages of decentralization? Well, the biggest thing is the duplication of costs, because if every area is kind of working as their own unit, there is going to be some overlap, people doing the same thing. And then potential problems achieving goal congruence, right? We have goals for the business as a whole that we want every division of the corporation to be working towards. And when we give the decision-making power, we let those individual segments of the business kind of operate as their own. They may have goals that are different than what the overall business strategy is. So we have to find ways to kind of keep those aligned. And so our performance evaluation system is where we provide the upper management with feedback. And so we want to have performance evaluation systems that clearly communicate the expectations. That's going to help with goal congruence, but it's also going to help with the manager's satisfaction and retention, as we said, and motivate them to do a good job, because that's going to be good for the company, but it's also going to be good for them as far as their annual bonus. And so since we're evaluating different segments of the business, this is what we call responsibility accounting, is where we want to track the performance of the individual segments so we can see how the manager did. So we call these individual segments of the business responsibility centers. Okay? And so responsibility accounting is how we track and evaluate how the manager performed. And there's 4 different types of responsibility centers: cost center, revenue center, profit center, and investment center. So a cost center is where the manager is only accountable for controlling the costs. So there's really only costs being incurred in this responsibility center. Example being the manufacturing plant. So the plant manager is responsible for controlling all of the costs. A revenue center is where the manager is going to be held responsible for generating revenue. So the manager in charge of sales territory, they are given a goal for their sales that they're to generate, and they'll be held responsible if they met the goal. Then we have a profit center. And here in a profit center, the manager is going to be responsible for both generating revenue and controlling costs. So a specific product line, managers held responsible for the sales of the product line, but also for controlling the costs of that product line. And then the fourth one is an investment center. So the manager is responsible for generating revenue and controlling costs, but even maybe even more important than that, managing the assets. So they're given an additional task, managing the assets. So this would be a division or a branch of a company. So let's take a look at some examples. So the assembly line at the plant would be an example of a cost center. Okay, they're only going to be in charge. The managers are only going to be held responsible for controlling the costs. How about a Chili's restaurant location? So we've got Chili's corporate. So the manager of a Chili's is going to be responsible for both generating revenue as well as controlling costs. They would not be responsible for managing assets. That would be decided at the corporate office. How about the legal department of a corporation? They would just be responsible for controlling costs of their department. They would not be responsible for generating revenue for the business because all they're doing is they're providing legal advice. They are not in any position to generate revenue for the corporation. How about Doritos, which is owned by Pepsi? So PepsiCo, big giant company, and we think of, Pepsi soda, but they also own a lot of other really big businesses, Doritos being one, Tropicana orange juice another. So the manager of Doritos would be held responsible for not only revenue and cost, but also managing assets. Doritos would be an investment center. What about the sales manager overseeing a territory? That would be an example of a revenue center. What about the produce department of a grocery store? So who's ever in charge of the produce department would be in charge of both revenue and costs. That would be a profit center. How about the accounting department of a company? Okay. The manager would just be in charge of costs. There's no revenue being generated in, processing the financial reporting for a company. So that's to distinguish the different types of responsibility centers. So now we want to look at how those managers will be evaluated. And so for a revenue center or a cost center, their performance report would just be comparing the actual to the budgeted. And then we would find a variance. What's the difference between the actual and the budget? And so a favorable variance causes operating income to be higher than budgeted. An unfavorable variance causes operating income to be lower than budgeted. So here's an example. We have a revenue center. The actual revenue was 108, the budget was 100. So for a revenue center, we can see the variance is the difference between actual and budgeted. So we've got a variance of 8. And then for a revenue center, it's good for the actual to be higher, right? If our revenue is higher, that's going to cause operating income to be higher. So that is favorable. If we're looking at a cost center, right? So if we're looking at the accounting department, they were supposed to incur costs of 100. Their actual costs were 108. Again, we've got an 8 variance. But when costs are higher, that's going to cause operating income to be lower. So for a cost that's higher, that's going to be an unfavorable variance. So that's how you would evaluate the manager of a revenue center or cost center. And so when we look at our variances, we have what's called management by exception. We could choose to investigate the largest variances, and we may set a threshold for the variances that we're going to investigate. So it might be a certain percentage of a variance, or it could be a dollar amount, or it could be a percentage and a dollar amount. Right? And so those are the ones that we are going to go and we're going to find out the reason for the variance. So talk to the manager involved, find out what happened. The manager needs to explain, right, why they had a variance. Okay, so when we're looking at segment reporting, and so this is going to be, we're going to be looking at a portion of the company, and we're going to see what their financial information shows. So which of the following is not a type of responsibility center, right? Well, we said profit center, revenue center, investment center, and cost center. So disbursement center is not a responsibility center. And so when we are looking at responsibility accounting for a profit center, we want to distinguish their fixed costs between the direct fixed costs and the common fixed costs. The direct fixed costs were incurred by that responsibility center. The common fixed costs are the costs that benefit probably the whole company or at least more than one segment, and they're being allocated to the segments. And so we don't want to just look at the operating income in total, because the operating income is going to reflect some of those allocated fixed costs that the manager didn't have a say in incurring. So to the manager, that's an uncontrollable cost. We want to look at the controllable costs of the manager when we evaluate them. And so the segment margin is going to be the operating income before the common fixed costs. So when we're looking at the segment margin, we start with our sales revenue. We subtract our variable costs to get to our contribution margin. And then we're not going to subtract all of the fixed costs. We're only going to subtract the direct fixed costs to arrive at the segment margin. This is what we're going to use to evaluate the manager. But then to get to operating income, then we'll subtract the common fixed costs that have been allocated, and that's how we get to the operating income. So the salary of the CEO of a company with several segments is likely to be which type of cost? Common fixed cost, direct fixed cost, variable cost, none of the above. We know it's not a variable cost, right? We know the CEO salary is fixed. It does not depend on the volume of production. This would be considered a common fixed cost that's being allocated. Every segment of the business is going to have to pick up a part of the CEO's salary. Certainly those managers did not have a say in determining the CEO's salary, so that would be an uncontrollable cost for that manager. They should not be evaluated on it. Okay. Let's take a look at an example of performance report for a profit center. So here we can see the North America segment for a business. So their sales revenue, variable costs, and then their fixed costs have been broken out between the direct fixed costs that were controllable by the manager and then the non-controllable costs, the allocated common expenses. So here's the actual and the budget, and we're going to prepare a performance report. So our starting point, that's not what I wanted to do. Take our sales revenue minus our variable costs. That's going to get us our contribution margin. Then we're going to subtract our direct fixed cost. And here we were given the actual and the budgeted. And so we will subtract the contribution margin minus the direct fixed cost, and that gives us the segment margin. We'll then subtract the common fixed costs from the segment margin, and that's how we get to the operating income. Now we can compute our variances by subtracting the actual and the budgeted. And we'll actually do that all the way down. Get the difference. So when we look at the difference, we don't think of it as a positive or negative. These are really absolute values. We're just going to then look at the variance and decide if it's favorable or unfavorable. For sales revenue, we see the actual was higher than the budgeted, so that would be favorable. For the variable costs, when costs are higher than the budget, that's going to be unfavorable. The contribution margin is higher than the budgeted. That is favorable. Direct fixed costs are lower than budgeted. When costs are lower, that's favorable. The segment margin, the actual is higher than budgeted. That's favorable. Common fixed costs those are favorable overall.